Please welcome the panel on Catalytic Capital, Investing for Performance, Purpose, and Planet. Moderated by Asia ESG and climate reporter for Bloomberg News, Ishika Mukherjee.
Thanks, everyone, for joining us today for the panel on Catalytic Capital, Investing for Performance, Purpose, and Planet. We're meeting against a backdrop where a lot of investments in the public markets in the energy transition theme are in the doldrums, not least because of tariffs and protectionist measures by various countries. And at the same time, a lot of projects in the private space remain uninvestable. Climate costs are rising as well. They're estimated to bring in damages of at least $38 trillion annually by 2050, by one estimate. So how do you really make returns in such an environment, and how do you bring in private capital, philanthropic capital, to really get money where it's needed the most? I'm joined by an esteemed panel today to help provide a dose of clarity on these topics. So thank you to all of you for joining us today. I'm going to let you introduce yourselves. Emily, why don't you go first?
Thank you, Shika. It's lovely to be here. Hello, everyone. I'm Emily Chu, Head of Sustainability for the GIC, Singapore Sovereign Wealth Fund. Our mandate is to preserve and enhance the purchasing power of Singapore's reserves. We're one of 3 reserves management entities that operate here in Singapore, and we have sustainable investing as one of our 5 core strategic pillars to guide our pathway to being a leading global long-term investor.
Deepali, would you like me to go?
Yeah, thank you so much, Ishika. My name is Deepali Khanna. I'm the head for Asia for the Rockefeller Foundation. I've been with the foundation for over a decade. My role is really to ensure how we amplify the foundation's impact and innovations to really ensure that opportunities become universal and are sustainable. I work across different ecosystems to really ensure that we can leverage finance, build collaborations. We also do catalytic grant making. And most importantly, we're trying to see how we can build effective public-private philanthropic partnerships, because as Ishika said, the climate crisis that we are sitting in warrants all of us to be coming together, and that's what one is trying to do. We are a 111-year-old foundation, and we've been working in the region also for over 100 years. Our mission has always been to serve the well-being of humanity, and that's what we continue to do. We do that by investing around big bets, and we look at our resources as high-risk capital, so constantly looking out for things where we can take bold risks, because that's really the need of the hour. And especially with the climate crisis, we need more of us in the room to be taking bolder, bigger risks to deal with the crisis that we are in.
Thanks, Deepali. Hero?
Hi, thanks, Ishka, and thanks, everyone, for having me here. My name is Hiro Mizuno. Now I'm a senior advisor to Milken Institute, and also I'm a senior advisor to MSCI CEO. Where I am trying to promote the the transformation of the benchmarking practice and all those risk management system for investors. And many of you probably just recognize me as a former chief investment officer of Government and Pension Fund of Japan. I run the fund for 5 years, where I really try to push the ESG as a main principle for the big asset owners' investment strategy. So I'm very happy to be with all these panelists to discuss the current status of ESG and climate investment. That'll be very interesting. Thank you.
Thanks. Robert?
So hi, I'm Robert Schultz. I'm a partner at Capricorn Investment Group. We're a $10 billion asset manager, been around for 20 years, focused 100% on sustainability and impact. We don't believe in concessionary returns. Everything we do is for a financial return for our investors and our families. And we pretty much invest everything we do on sustainability and impact. Climate's our main focus. That's probably 85% of what we do.
Okay, thank you. Before we begin, I want to do a quick temperature check. How many people in the audience, if I can inconvenience you for a second, are actually investing today with the aim of having better environmental or social outcomes? That's a better number than I had imagined, so yeah, good to know. But that debate between returns and doing good is still very much present in the sustainable investing space. I'm going to start with you, Robert. Capricorn invests billions in emerging markets via your portfolio funds. And there was a Global Impact Investing Network report that found that 79% of the people they surveyed, which is about $300 billion in AUM, was actually achieving in line or better returns than they had expected from their impact investments across various public and private market instruments. Why are we still having this debate today about returns and doing good? And where do you see the best opportunities in terms of your risk and return profile over the next 12 months?
So, I mean, we're not trying to market. I mean, we think our returns are very, very good. We tend to beat the benchmark all the time. We focus 100% on impact and sustainability, as I said. It's a difficult conversation. Most of our LPs are family offices that really understand what we're doing. So it's not a difficult conversation when I go talk to my family offices. They say, okay, great, we want to do this, we love what you're doing. Where the difficulty becomes, and I hope there's not too many of you in the office, in the room, is when I talk to pension funds, it's just a different model. You know, they have a different return target, and our return targets are pretty high. So as a result, as you expect, there's a bit more risk associated and some volatility. So the larger pension funds, institutional investors that make a predominantly amount of money, really aren't looking for teen-digit returns. They're looking for single digits with a guaranteed kind of cash flow, and so that's the problem. So the bigger allocators that have the more money, they're the ones that are kind of stifling what I think is the opportunities in some of these areas.
So where do you think the best investment opportunities are right now?
Well, so we're an early stage investor, so we do very early stages in deep technology. For example, we were one of the first investors in Tesla. We're in QuantumScape, battery storage. We also have a GP stakes business where we invest in emerging managers that are focused on impact. So we look at young managers that have maybe one fund, or they're looking at for their first fund, and we'll seed them and help them grow. So for us, we like difficult markets. Right now, we're very focused on the voluntary carbon markets. I know there's a lot of negative press, and it's a difficult situation, but we think that's super important. If we go to the goal of net zero and carbon neutrality, we think the VCM is where you got to be. So we're looking at a lot of that area. But we also look at fusion and hydrogen, things that haven't really been proven out yet. But we're okay with that because we're taking that risk.
Okay. Emily, what about you? What's GIC thinking about in terms of the energy transition? Where do you see the biggest investment opportunities in the clean energy space right now?
If you don't mind, before I address that directly, I think it's important to have the overall North Star for GIC. We have three core principles when it comes to sustainability and investing. The first is that we believe that companies or assets that are managed well in relation to sustainability factors are more likely to perform well in the long term. And our time horizon is very long term. We truly are long term. We measure our performance over a 20-year period, which I think is relatively unique and gives us the opportunity to really think about systems transformation over time. The second principle is that we take a holistic view. So we want to protect the overall portfolio. We invest across all major asset classes in public-private. We're very global in the way that we invest. We want to protect the total portfolio from clear risks, whether that's stranding or other types of risks that come from sustainability factors. We do want to allocate to where the opportunities are, and I'll get to that in a minute. And then the vast majority of what we invest in needs to transition. So we don't take a rules divestment-based approach to sustainability. It's a lot more bottom-up and nuanced than that. And the third key principle that forms our North Star is that we believe in the opportunities in real-world decarbonization. And we want to make a contribution to that real-world decarbonization. And we prioritize that over portfolio level target setting. So we have not, for example, adopted a net zero target, but we do believe in the net zero transition. And that's where we want to be allocating capital. So to help us understand where the investment opportunities are, We do a lot of kind of top-down research, sector-based research also to help create the intellectual assets for our investment teams to be able to more effectively allocate capital and to make those choices. And towards the end of last year, we co-published with the World Economic Forum a Decarbonization Opportunities Explorer, which essentially looked at known technologies and looked at the potential incremental value add from those technologies, and overall found that there's potentially up to a 5 to 11 US trillion incremental value add investment opportunity by 2030. The known, the kind of proven technologies where we think there are clear and present opportunities right now include electricity networks, so grid modernization, sustainable vehicles, solar, wind, obviously, the renewable energy, lithium, so kind of upstream minerals is an interesting area, and heating and building transformation. And some of the more nascent opportunities that we're interested in also include hydrogen and EV charging infrastructure.
And where are you finding these opportunities? Is it all in Asia or in the US?
No, globally. I mean, we invest globally, and so we see the opportunities are available everywhere. I think in developed markets, there's been more support perhaps for some of the infrastructure build. However, the framing that we bring to our bottom-up investment decision-making, whether it's infrastructure or public markets, is really one around policy, markets, and technology. So the policies do need to be supportive. However, we try not to invest in a way that's dependent on policy. Obviously, having a clear carbon price signal through policy is very helpful, but we don't want to be dependent on that for the investment value. We think of it really more as potential future upside if prices were to become clearer. The markets have to be clear. There has to be a clear supply and demand equation, and then the technology has to be viable. It has to be proven.
Okay, thanks for that. Hiro, what about you? So you are an ex-CIO of GPIF, the world's largest pension fund. What was the returns landscape now? Where is it today? And where do you think the investment opportunities are when you're looking at doing good, if I can say that?
Sure. Let me first of all, answer your question to Rolf, like where,
Okay, sure. Go ahead.
I think the relationship between doing good for the planet or society and the financial return, everybody always start by asking like, there's a trade-off relationship between doing good and the financial performance. How do you deal with that? But I have been commissioning so many researches, and I've been studying, all those the academic research on that return, and then the ESG and the inputs. And recently, I joined the MSCI Sustainability Institute, where we are having like a meta research of all those data. And let me clarify: there's absolutely no evidence there's a trade-off relationship. And then even when I was running a GPIF, when I asked the people to change the benchmark to kind of like reduce the investment universe to a better a carbon efficiency of the portfolio, the initial pushback is always the same, reducing an investment universe will result in a poor performance. But again, there's no evidence. And I even asked for asset managers, why don't you create the hypothetical portfolio, assuming there's no change to the benchmark, and show us the comparison which performed better. And nobody said we would. So I think we just first of all need to understand the reality. There seems to be no evidence that the taking those ESG or sustainability into the investment decision making will result in poor performance. So if there's a performance will not be affected, why don't we do something good at the same time? And that's one way to take a look at it. And the other way to take a look at it is, although market hasn't appreciated yet, the businesses which have the positive impact on these sustainability factors of the society and the planet, if we believe those kind of business will succeed and will deliver more value to the portfolio in the future, we should definitely shift the money into those companies or those businesses. So there's two different ways to take a look at it. But I always think it's really up to the investor or asset owner to decide which approach they want to take.
Yeah.
But I think one day, all the people who believe in ESG and the sustainability feels that one day the market will catch up and actually the price fairly those factors. And once then it happens, it will impact somebody's performance of the portfolio. So whether you want to be prepared for that or just wait until then, that's a question. In terms of the responding to your question, which I think is a good investment, a change in the opportunity is, I think a lot of technologies, a lot of like the green businesses we were talking about when I was running GPF before COVID is now kind of materializing and going into the stage of really requires real investment. So it's more, it's a shift from investing into ideas to investing into real, the real infrastructure or real real businesses. So that shift should be happening probably much quicker, but it's still happening at a slow pace. And all those ESG integration and consideration sometimes works in an opposite way to just pull the investor back from investing into those transitions. So as Emily mentioned, a lot of people, particularly in Asia, we are being aware of the importance of transition finance, even before Europe, caught up on that idea. So I think we should have concluded our discussion, which is green and which is not, but we, at that moment, have to really work on how to achieve it, how to effectively achieve it. That's why I think the transition finance is important. And the transition finance, sometimes we really couldn't get the very good equation of risk and return, where I think somebody like Rockefeller will be able to, add some another aspect or characteristic of the capital to just balance the risk return for the institutional investors.
Yeah, absolutely. And we'll come to transition finance. Deepali, so philanthropic capital right now is not yet able to meet the needs that are required, say, for us to transition to a low-carbon economy. We need $4.5 trillion of investment annually by the mid-2030s, if I'm not wrong. And philanthropic capital total $1.5 trillion in total by the end of 2022. So there's obviously like a funding gap from the philanthropic side there. What are you seeing in terms of where concessionary capital is making a dent now and making projects investable for, say, private capital to come in over the next 12 months? And what are some interesting deal structures you're seeing where people are actually interested in putting their money on the table?
Yeah. So, Ishika, as we are seeing right now, we have a huge climate finance gap. The resources, we need about $3.8 trillion annually. The moment to act is now because, climate is not knocking at our door, it's here. So first, as a foundation, it's all about walking the talk, right? So last year at the UN General Assembly, we made a commitment of $1 billion over the next 5 years on climate issues. So that starts with ourselves, which is grant money, debt, equity, and looking at different blended finance instruments. As part of a climate strategy, we have two important pillars. The first one being, how do we really get the world together to be working effectively on climate issues? Because none of us can do it alone. So that's one pillar. The second one is, how do we really ensure that the climate transition opportunities reach the billions of people who are being left behind? And that's why when I was looking at the topic, catalytic capital investing for performance, purpose, and planet, let's not forget the people. They're really being hit day in and day out very severely with the climate crisis. So that's one part. So programmatically, we're putting all our resources behind what we made a commitment towards climate. Even in terms of our operations, we're really looking at scientific standards of how do we get to a net zero within our operations and have made a similar commitment around our endowment as well. So, we've been talking a lot towards understanding what the investors are really looking for. And I think people seem to be very optimistic about climate finance, but, there is need for grant capital, there's need for blended finance instruments, and that's where philanthropic money can come in very handy. I think in terms of our own endeavors, we seeded something called the Global Energy Alliance for People and Planet that happened at COP27, which is addressing energy access and transition issues through that entity, which 3 foundations came together, put in $500 million each, $1.5 billion. We've been able to leverage another $9 billion from DFIs, bilaterals, and multilateral development banks. That's for the first time in history where this kind of a platform is standing up. We're very excited about the opportunities now with this platform that has been created at last COP as well. We announced a battery energy storage consortium that this platform has set up. Now, again, 5 gigawatts of battery storage is kind of, with 10 countries coming together, is pretty significant. So, these are ways in which we are kind of using our resources to really get things moving. We've also had some phenomenal experience, with some of the other entities. For example, there's an entity called Samrid, or Sustainable Access, Access for Markets for innovating delivery of the health sector, where between 12 institutions, philanthropic institutions, we put in $13 million, been able to leverage $300 million. Similarly, we have something called the Zero Gap Fund, where we came together with Rockefeller Foundation. Between the two of us, we put in $30 million, and we've been able to leverage $1.2 billion. So, there are various ways in which we've been able to really use our grant capital, get some innovative financing mechanisms in place to be able to really have business models that can attract commercial capital, because I think that's really the need of the hour. How are we going to be looking at blended finance, catalytic finance, complementary finance, and everything that comes in between to really get the private sector to be part of this journey?
I know you mentioned battery storage. Are there any other examples in terms of blended finance opportunities where you're seeing the sector open up to commercial capital now because of the work you've done? Where can private capital go at this point?
So the work that we've done around renewable energy, and again, we started our journey way back in 2014, 15, when we said, ending energy poverty. We weren't even making a connection with climate at that point of time. But we felt that renewable energy would play such an important role to drive economic development. And that's when we really started understanding from the private sector to begin with, because the government was doing everything when it came to subsidies to really trigger the renewable energy market. But we said, private sector is going to be playing a very important role, and let's really understand as a foundation what the needs of the private sector are. So there were 3 things that the private sector said they needed. First was, a mini grid at that point of time, which was kind of a 30 kilowatt plant, would be serving 250 households in a village. It would cost about $50,000, $60,000. At that time, renewable energy was expensive, right? And so they said, well, if you're going to be putting up a mini grid, what if the grid comes? Our investments are going to be wiped out. So we want an enabling policy framework where our assets are going to be protected. The second thing was that, they needed debt financing because there wasn't, they couldn't attract commercial money for that. The third piece was they weren't convinced that poor communities will pay, because in a lot of countries in Asia, whenever elections happen, the first promise that parliamentarians make is free electricity, right? So what happens to the private sector when these announcements are made? So we said, fine, as a foundation, these are the 3 things. We'll create a one-stop shop that addresses the needs of the private sector. We picked up a handful of private sector companies and gave them debt financing, worked on the policy framework with the government of India. Also, were able to get repayment rates as high as 99.7%. Poor people are willing to pay as long as they are sure they're going to get access to affordable energy, and that's what they did because they could drive their livelihoods. So, we started in India with this work, and of course, suddenly Tata Power came into the picture, and they said, we want to do 10,000 mini-grids, and there again, that really changed the market dynamics. So we've been really trying to understand where and how our grant capital can really leverage resources. We're not just looking at, hey, we're going to be doing good, but the doing good should be able to really multiply, because with the climate crisis, that's really the need of the hour, Ishika.
Robert, and then I'll come to you, Emily. Have you looked at any projects which are now investable? And we talked about the Inflation Reduction Act as well, right, in terms of grants and concessions and subsidies. Any area that's looking more investable to you right now than in the past?
Well, let me, Yeah, I mean, obviously we're deeply invested in nuclear fusion, hydrogen.
Right.
We're looking at ways to like electrosteel, making steel through renewable electrolysis. So we're looking at those kind of areas. What unfortunately we don't do, and this is to what Dipali says, is that we actually don't invest in renewable projects. We think renewable energy is super important, but we can't do that though. I can't invest in German solar with a 4% return or U.S. wind at like 8% return, even if I leverage it.
Yeah.
The return profile is too low for us. And it's kind of tricky because we believe it's super important, but our LPs aren't going to want that kind of return profile. So it's the bigger infrastructure players or their foundations or other groups that can do that. We just can't do that. So there's things that we should do, but we can't because we can't make a big enough return.
Okay.
And it's not to what Hiro says. It's not that impact investing is concessionary, but it's just the nature of renewables and what happens. It's a really big pension fund play.
Right.
So I mentioned some areas earlier where our decarbonisation opportunities, market sizing work is guiding frameworks for our asset class teams to actually implement. And I think that it's quite difficult to answer your question because it really depends on the geography and the asset class that you're in. So what GIC did is several years ago set up a sustainable investment fund, which was essentially a multi-asset class fund to experiment with the idea of allocating capital to pure play sustainability themed companies or sustainability oriented opportunities. Okay. And then a couple of years ago, that essentially evolved into 4 different dedicated portfolios across asset classes. So in the public markets, we have a climate opportunities fund and a climate transition fund, where you've got climate opportunities oriented towards pure play solutions providers. The climate transition fund is oriented towards the transition story. So hard to abate sectors where you can allocate to companies that are better positioned than others to benefit from the transition and to get ahead of the transition. Quite different angles, but both investment opportunities. Right. Similarly, we have a transition strategy fund in fixed income. And then in the private equity group, we have a sustainable solutions fund that is looking at the earlier stage technologies. And there's opportunities there too. And I've mentioned some of the areas. It's all this kind of similar areas. What's new for this year and something that I'm excited about when it comes to the topic we're addressing, which is catalytic capital, is that through the experience of investing across these different asset classes, we started to identify that there was a class of company or a class of technology that, once it was past the VC or maybe early growth stage, was moving into a need for finance or capital. Maybe they're still high capex companies, but they're not going to give the kinds of private equity returns. So, Rob, you mentioned this issue. They're not going to give the kind of private equity returns, but perhaps from an traditional infrastructure asset class perspective, there's still relatively more technology risk than a usual infrastructure investment. Yeah. So we've established a new initiative internally called the Green Assets Program, which is really trying to address the idea that there is a need to create this bridge of capital for companies that are a going concern, that are operating in the climate transitional climate solution space, but which don't kind of fit the traditional characteristics of the traditional asset classes. So it's not exactly blended finance, but I do think it is kind of providing that bridge, and it's catalytic in that form. One of the companies that we've invested in that I think is exciting is a company that was formerly known as H2 Green Steel, now known as Strega. And this is addressing the idea that there's a need for less emissions-intensive steel production at scale. I don't think that, even a few years ago that this would have been possible. I think with all of the need, the kind of development of hydrogen as a potential technology there, there's more opportunities now to replace coal as a feedstock in the production of steel. So that's something that that's an example of how we've placed capital.
Okay, thanks for that. I wanted to shift focus to passive investments for a second. So Hiro, I know you are a special advisor to, did I get that right, to the CEO of MSCI.
Yeah.
And ESG indexes have been, butchered a lot for not being very representative of the themes that they're supposed to be built upon. You have NVIDIA, TSMC are the top holdings in many of these index funds or indexes that are supposed to be ESG, right? How do you see the index space evolving? What are you advising? And I mean, do you think passive investments are necessary in this space, or do we need more of active funds to play a role?
Well, first of all, like the the index investment is actually becoming very popular, and particularly from the voting power perspective, it's for the any company listed company's CEO. It's hard to ignore how the passive fund manager is going to vote, and then that's quite an interesting phenomenon because they are now let's say most American and also probably Japanese and all the other major stock market companies, the biggest shareholder is a passive manager who made no active decision to become an owner of the company. So you are facing the situation like the ownership decisions, and also the way they approach the management through their engagement or stewardship is not very well aligned. So in those circumstances, I think the long-term investor like like sovereign wealth fund like a GIC or the GPF, like a big asset owner, have to make it very clear. They actually wanted to guide all those engagement to promote the long-term sustainability of the business, because it usually should be reflected in the ownership decision, but it's not.
Yeah.
So that's one thing happening in the area of index. The more investors or owners' participation in the dialogue with the company, not through the ownership. And then not through the ownership decision. And the second is the big asset owners, particularly the pension fund, the majority of their portfolios or the money destination of their money is actually dictated by benchmarking selection. So at the moment, the most of the major asset owner use the MSCI ACWI or like for the US like SP 500, very simple benchmark, which doesn't integrate their philosophy or their long-term investment strategy. So there's a big gap between where that fund management or governance believe the market should be going or the economy should be going, and the way their CIO and a team is instructed to manage their money. So I think one of the things which I think should be happening is all the big asset owners, the trustee board and those people probably should revisit their choice of the policy benchmark. And if they believe that their portfolio should, of course, need to make money as a fiduciary investor, but at the same time, they want the portfolio to be prepared for the future, I think they need to make the governance level decision to just change the benchmark. And MSCI is trying to provide all those different, the benchmark for the use of that kind of strategic choice. Right. But at the moment, very few have done. I tried at the GPF, they didn't do it. And then I think a lot of people like Californians, they tried, but the board is basically telling the CIO to make the money and change the portfolio, do more climate investment, but I'm not going to change anything about the benchmark, which is almost an impossible mission. Right? Okay. So that's something we really need to raise the awareness. Regardless all the effort made by investment partners like a sustainability officer, the lack of attention to the high-level benchmarking practice is not going to really change the portfolio. Okay. So that's one of the things I think the MSCI and the other benchmark providers should involve the high-level senior executive to discuss.
Yeah. Fair point. We've talked about returns, and I'm mindful of time. We're going to have to whiz through the risks here. Deepali, maybe I can start with you. So you mentioned that there's a climate risk tool that you use which help inform public finances. Can you tell us a bit more about that and how that's informed your investment decisions?
Yeah. Let me just go back, just two comments. Yeah. So one is, of course, as we're talking, there's still money on the mitigation side, but on the adaptation side, there's no money. Yeah. Right? So there again, as foundations, we're really trying to see how we can get more money flowing into the adaptation side, because that's equally important. I think the other piece I wanted to mention is also going back, Robert, to your question around renewable energy. So with the battery energy storage platform that we've created, we are seeing that where we can kind of couple battery storage along with renewable energy, the costs are coming down to less than what fossil fuel costs would be. So again, hopefully we can drive markets around that piece. Also, we've been working around early retirement of coal plants, and we have an interesting pilot that we're doing in Philippines, where again, the first thing is, of course, to have a robust methodology, because we do know all the sentiments around carbon financing methodologies and how transparent and effective they are. But, again, renewable energy will be playing a very important part as we're kind of looking at phasing out of some coal plants. And, as an entity, as an institution, we're saying over the next couple of years, if we can get a significant number of successful models, and that, again, make a significant dent when you look at renewable energy. I guess coming back to your question, Ishika, which you probably may have to repeat for me very quickly.
Your climate risk tool.
Yeah, so I think, based on the conversations we've been having with government, private sector, one of the things that we noticed was that, there's a lot of public sector resources that are available. You're looking at national banks across, for example, India. What really is preventing them from getting the money out of the door is their ability to really have some climate risk tools. So we have been able to work along with the Coalition for Disaster Resilience Infrastructure, which is an entity, it's a member state organization, to develop this tool that is helping entities like the Reserve Bank of India to be able to really see how they can really ensure that this is something that is adapted, to get more of the public sector finances to the places it can be. I think linked with that also, what we aren't seeing and more needs to be done, and again, that's where philanthropic money can come in very handy, is capacity building. I think we're just all assuming that we all have the capacity, particularly within the public sector, around how to deal with the climate issues, right? I strongly believe that even today, if all the money were to be made available, are we going to be able to address the climate crisis? No, because we don't know where and how it needs to be put effectively, how do we need to be sequencing things. So again, foundation money, grant money to really build capacities, capabilities to begin with the public sector, so that the kind of policies, regulations, et cetera, that are really needed to then get the private sector to be able to do what it does best is something that we're really kind of also investing in, and is something which is reaping benefits.
Okay. Emily, I know GIC has this big climate risk tool and policy framework.
We've got a number of, to deal with climate, I'll try to be super quick.
I know. Wait, but can I ask you a point of question,
sure.
because we're running out of time? Like, what are sort of the stranded assets in Asia that are the biggest, that you've identified right now, which are the biggest risk right now to your portfolio?
I mean, we've identified a very, very limited number of business models that we think are, because of climate transition, are likely to be stranded. That's not specific to Asia. We're a global investor. I would say that, to deal with climate risk, we've rolled out climate scenarios for our total portfolio to guide. We're still in the process of building this out, but to help guide asset allocation and to help guide our long-term returns expectations. We've rolled out a carbon transition risk valuation tool that looks at carbon pricing, among other things. We've rolled out physical risk tool, particularly for our real assets and infrastructure business, that's essentially looking at exposure of assets to greater risk, physical impact from different changing weather patterns. But then obviously every risk is also an opportunity. So in identifying the assets most at risk, you're able to identify the companies that are better placed for transition, but also the companies that are better placed for physical adaptation. And then as there is more and more physical impact from climate change, we're also starting to look at the opportunities around adaptation finance as well, and what can actually be expected of a private returns-oriented investor like GIC. Where can we expect to be able to place capital relative to what governments will be needing to do to adapt?
Have you decided on anything yet?
Nascent research in that area, but we see there are some companies that are, or some assets that are highly exposed to physical impact that are better positioned. So that's the relative selection game. And then you have proven technologies like HVAC and cooling roofs and what else did I have in here? Seawalls, like these, you're going to see a paradigmatic shift in the demand for these known solutions. And then emerging solutions like precision fermentation, precision agriculture, new types of health solutions for tropical diseases. These types of things are less proven, but are emerging opportunities that we're trying to keep our eye on as they become relevant.
Cool. After climate risks, I want to touch upon geopolitical risks, especially ahead of the US election, the big US election. Robert, when you're thinking about next year, how are you factoring in growing protectionism and the US election outcome? How are you hedging for it? How are you thinking about navigating geopolitical risk for your portfolio?
So, look, I mean, we obviously consider everything. It's any prudent investor will look at that. When we look at companies or asset managers that we invest in, we look at their financial model and what they're doing, and we're looking for companies and managers that aren't relying a large amount on financial incentives. Look, every single industry is driven by government incentives. Let's be clear, no matter what it is. But the IRA is really tremendous in the U.S. It's unbelievable. But if someone came to us with a model whereby, the bulk of their revenues are IRA generated, it just doesn't work. You have to build a business that's sustainable long term because there will be elections and there will be changes in government and changes in policy. So clearly it's been super instrumental to build in the US. And Europe has followed with the same kind of ideas. But you can't build a business model relying upon government incentives. Yeah. So when we look at our investments, we really make sure the companies understand how to do this. And yes, it's an added benefit, but we will discount anyone who is really relying upon that as their future success.
Hiro, thinking ahead to 2025, we've seen how tariffs have really affected the investment case for China, for renewable energy, all their exports in that space. What do you think is going to be the number one regulatory or otherwise risk in 2025 to investment portfolios?
2025, I think the biggest risk is what happens to the U.S. and consequently the U.S.-China relationship, because we are so much depending on Chinese supplier to build our green infrastructure. And then at the same time, there's a battle over an EV and a battery, and then that itself is shouldn't be strategic, but the U.S. regard that as a strategic products. So I think the concept of the national security is actually expanding from the military tension to the economic tension, and then all of those are potentially hinder and set back a lot of progress in a green, the economy, and then that's where a lot of us is betting as an opportunity. So, EV is a good example. I worked on the Tesla board, and then now people feel like EV is now, they're slowing down, and the people, companies changing strategy. But in reality, the backdrop is people are very, very concerned about whether they can get enough supply while decoupling China. So I think, it has been an elephant in the room to talk about China, but now it's probably the elephant getting out of the room, and it just we really need to figure out a way to how to navigate it. And then the U.S. election definitely make it even more difficult or less difficult. But I think the how to deal with an integrated China into global supply chain and how to navigate maybe the phase out is going to be critical risk for everybody's portfolio.
I have so many more questions here, but we're running out of time. If you have 10 seconds each, just top of your mind, what's the next big new product or financial innovation that you're looking forward to in the environment or social space? Robert, would you like to go first?
Sure. I mean, we're an early stage investor. We still think fusion is super important, so we really like that business. That's what we're looking at. We also, as I said earlier, we really like the voluntary carbon market space. We think it's super important to get to net zero and carbon neutrality. I mean, people can say whatever they want, but planting a tree is not a bad thing.
Yeah, Hiro, what about you?
I must say electric motorcycle.
Oh my God. Way to make a plug. But okay.
Well, I think we at least prove it's cool product at the closing ceremony, the Paris ceremony. Did you see the Tom Cruise riding the Harley's electric vehicle?
Deepali, what about you?
Instead of the product, I really feel that, leaving this room, we need to have much more dialogue between public sector, private sector, and philanthropic sector, because I think climate is affecting all of us. The need to act is now. We need climate security. None of us can do it alone. So how do we really kind of work together towards not a financial product, but something which is really going to be in the interest of really saving all of us from where we are. So we should be looking at really scalable stuff that we can't afford to do small things here. So that's really a plea from my side.
Emily?
3 areas we're looking at right now. They're not investment recommendations, but grid modernization technologies, critical mineral supply chains, and then energy-efficient, water-efficient data centers.
Okay. Damn, you end with data centers.
Yes.
But the monitor is telling me time's up. Thank you very much for this very engaging conversation, and please join me in giving them a round of applause for such a nice chat. Thank you very much.
Thank you.